Hello again, fellow BeachBum traders. Thank you for joining us for our video, What is a Leveraged ETF and How Do They Work?, which will be the first video in a series of videos on leveraged ETFs and how they work. We've had a number of requests by members of our BeachBum trading community asking questions about leveraged ETFs and how they work, and requesting that we do some videos on explaining leveraged ETFs and how they work. So again, this will be our first video in this series on leveraged ETFs, where we'll strive to help you understand leveraged ETFs. How do leveraged ETFs work? How can you trade them? How can you make money using leveraged ETFs? And what are the risks, so that you understand both the risks and the potential rewards of using leveraged ETFs to succeed in your trading career. So we hope you will come back for all the other videos in this series on leveraged ETFs, and we hope this all helps. Let's get started. Okay, we'll start looking at what is a leveraged ETF using this article from Investopedia. It's a good article, basic definition of leveraged ETFs. What is a leveraged ETF? I'll leave the direct link to this Investopedia article in the description box below, so you can read it in more detail at your leisure. So if we just start with a basic definition of what is a leveraged ETF, a leveraged ETF, a leveraged exchange traded fund. An ETF is an exchange traded fund. Is it a marketable security that uses financial derivatives? And again, you can click the link to get a definition of what is a financial derivative, and debt to amplify the returns of an underlying index. So it's based on an index, and the goal of the leverage is to give you leverage to amplify the returns of the underlying index. While a traditional exchange traded fund typically tracks its securities and its underlying index on a one-to-one basis, a leveraged ETF may aim for a 2-to-1 or 3-to-1 ratio. So again, a leveraged ETF is a way to gain leverage and amplify your returns relative to the index underlying the exchange traded fund. Leveraged ETFs are available for most indices, such as the NASDAQ 100, the Dow Jones, etc. Some examples of some leveraged ETFs that you'll hear the ticker symbols for are like SQQQ, which is short on the NASDAQ 100, TQQQ, which is long on the NASDAQ 100. And again, as you can see, there are both long and short leveraged ETFs. So again, one of the benefits we'll talk about for leveraged ETFs, and probably go into more detail in subsequent videos, is the fact that you can use leveraged ETFs as a way to short in retirement accounts like IRAs, Roth IRAs, 401ks, etc., which do not allow directly shorting in individual stocks. So again, one of the benefits of using leveraged ETFs, and again, we'll go into more details in those regards in the future. Again, some other examples of leveraged ETFs on commodities is for natural gas. There's some called Boil and Cold, KOLD, to long and short natural gas, Gush and Drip to long and short oil. On the S&P 500, there's like SPXU and SPXS and SPXL, which are all examples of leveraged ETFs to long and short the S&P 500. And again, there's a whole plethora of leveraged ETFs with different ratios based on different indices to allow you to long or short indices, commodities, even some currencies, etc. So some key takeaways: a leveraged exchange traded fund or ETF uses financial derivatives and debt to amplify the returns of an underlying index. While a traditional ETF typically tracks the securities on a one-to-one basis, a leveraged ETF may aim for a 2-to-1 or 3-to-1 index. And again, as we'll talk about in more detail, it's important that you understand the definition of the particular leveraged ETF. What ratio is it trying to achieve? How does it achieve that ratio? And again, What types of derivatives is it using? When does it rebalance? When does it recalculate? And again, these are all more details. We'll go into more details as we progress in this video, in this series of videos on what are leveraged ETFs and how do they work and how can you trade them. Leverage is a double-edged sword, meaning it can lead to significant gains, but can also lead to significant losses. So again, it's amplifying the returns of the underlying index. So as we'll see, if the index goes up, it amplifies the rewards to the upside, higher rewards. If the index goes down, it amplifies the losses and the risks to the downside. So again, it's amplifying the return, so it's amplifying both the risks and the rewards in some proportion. Okay, as you will see in this leveraged ETF definition article from Investopedia, again, you can get the link to this in the description box below. They have an embedded video, so let's watch this video together, and then we'll continue with our own commentary on what an ETF is and how do they work.
Leveraged ETF. A leveraged ETF uses financial derivatives and debt to amplify returns in relation to an underlying index. A leveraged ETF follows daily changes in its underlying index. But using leverage means that in order to increase the investment and realize bigger returns, it borrows money from a bank or an investment firm, or it repeatedly invests in derivative contracts such as options and futures. A leveraged ETF will typically try to double or triple the underlying index's daily return. For example, Elizabeth the investor buys a leveraged ETF that intends to double the return or maintain a 2-to-1 ratio of the S&P 500. She pays $100 per share. The next day, the S&P climbs 2%. Elizabeth's shares climb to 4% in value to $104 each, not factoring in management fees and transaction costs that can be quite high. That 2-to-1 ratio can have a negative effect as well. ETFs riskier than ETFs that are not leveraged. If the index had fallen 2% on the first day, Elizabeth's shares would be worth $96 each, fees and costs excluded. Leveraged ETFs are best used in the short term by sophisticated investors or those who can afford the added risk. Since they rebalance their positions daily, leveraged ETFs usually lose money over the long term if they fluctuate widely. Consider Elizabeth's ETF after the S&P gained 2%. Say the index loses 2% the next day. Elizabeth's shares don't return to $100. They fall 4% from their $104 value down to $99.84.
Okay, let's continue our discussion on what is a leveraged ETF. Again, in this Investopedia article on leveraged ETF definition, which you can find the link in the description box below. You can see they explain that leveraged ETFs are funds that have a basket of securities, or ETFs in general. Exchange traded funds in general are a basket of securities that are from an index or some kind of grouping. For example, ETFs that track the S&P 500 contain the 500 stocks in the S&P. Typically, if the S&P moves 1%, the ETF will move 1%. Again, that would be an unleveraged ETF. A leveraged ETF that tracks the S&P might use financial products, derivatives, as we discussed previously, and or debt that magnify each 1% gain to 2% or 3% gain, or correspondingly a loss. The extent of the gain is contingent on the amount of leverage used in the ETF. So again, it's important to know, is it a 2x leverage, 3x leverage, etc. Leveraging is an investment strategy that uses borrowed funds to buy options and futures to increase the impact of or amplify the impact of price movements. Leverage can work in the opposite direction as well and lead to losses. If the underlying index falls by 1%, the loss is magnified by the leverage factor. So leverage is a double-edged sword, meaning it can lead to significant gains, but can also lead to significant losses. Investors should be aware of the risks to leveraged ETFs, since the risk of losses is far higher than those of traditional investments. Also, factor of consideration is the management fees and transaction cost associated with the leverage fees can diminish the fund's return. It's also important to understand, again, the leverage in leveraged ETFs and where is that derived. So they explain a leveraged ETF or exchange-traded fund might use derivatives such as option contracts to magnify the exposure to a particular index. It does not amplify the annual returns of an index, but instead tracks the daily changes. Option contracts grant an investor the ability to trade an underlying asset without the obligation that they must buy or sell the security. Options contracts have an expiration date by which the action must be completed. So again, there's a link if you're not familiar with trading options and the various factors in consideration of trading options. You can click on this link here. Also, we have subsequent or further videos on trading options. And again, another benefit of these leveraged ETFs, if they do trade in options contracts and you are in a retirement account that does not allow you to trade options, this may be another way that you could benefit from opportunities and options through the use of a leveraged ETF, which is using options as one of the derivatives to amplify their returns. Options have upfront fees known as premiums associated with them that allow investors to buy. As a result, options layered within an investment such as stocks can add to the gains of the holdings of the stock investment. In this way, some leveraged ETFs use options to add to the gains of traditional ETFs. Portfolio managers can also borrow to buy additional shares, further adding to their position. A leveraged inverse ETF uses leverage to make money when the underlying index is declining in value. So again, the concept of shorting, when something is declining, the leveraged ETF is going up when the underlying index is going down. In other words, an inverse ETF rises while the underlying index is falling, allowing investors to profit from a bearish market or market decline. So another benefit of leveraged ETFs is the ability to make money in a downtrending or bearish market. And again, benefit is in a retirement account where you're unable to short individual securities, individual stocks. One way to make money in a bearish or downtrending market is through the use of leveraged inverse or just general inverse ETFs. And again, we'll have subsequent videos talking about inverse ETFs in general and leveraged inverse ETFs specifically. For every potential reward, there's a corresponding cost. So what is the cost of leverage in these leveraged exchange-traded funds or ETFs? So along with management transaction fees, there could be other costs involved with leveraged exchange-traded funds. Leveraged ETFs have higher fees than non-leveraged ETFs because premiums need to be paid to buy the options contracts as well as the cost of borrowing or margining. Many leveraged ETFs have expense ratios of 1% or more. Despite the high expense ratios, these funds are often less expensive than other forms of margin. Trading on margin involves a broker lending money to a customer so that the borrower can purchase stocks or other securities with the securities held as collateral for their loan. The broker also charges interest rate for the margin loan. So again, another benefit of using leveraged ETFs, leveraged exchange-traded funds, is even though their expense ratios are higher than other types of ETFs, it can often be cheaper than trading on margin. And again, it doesn't have the risks of margin calls, etc. Some of the other risks associated with trading on margin. Also, many most retirement accounts don't allow you to trade on margin. They're cash only. So again, this is a way that you can make money trading using leveraged ETFs with some level of leverage. Another benefit is when you're trading on margin, as you can see, the broker also charges interest rates. So when we're in an environment with raising interest rates, the cost of that margin increases. So again, the expense ratio on the leveraged ETF may be much cheaper than trading on margin directly. For example, short selling, which involves borrowing shares to bet on a downward or bearish move, can carry fees of 3% or more on the amount borrowed. The use of margin to buy stock can become similarly expensive and can result, as I mentioned, in a margin call, which you could lose money, irregardless of your desire to hold the position or not. A margin call happens when a broker asks for the money to shore up the account if the collateral securities lose value. So again, there's a number, even though leveraged exchange traded funds, leveraged ETFs have higher fees than traditional ETFs, they may be cheaper than directly shorting or trading on margin directly. Okay, let's talk about how leveraged exchange traded funds or leveraged ETFs are used. So here's some discussion on leveraged ETFs as short-term investments. You can see they mention that leveraged ETFs are typically used by traders who wish to speculate on an index or commodity, etc., or take advantage of an index short-term momentum. Due to high risk, high cost structure of leveraged ETFs, they are rarely used as long-term investments. So again, leveraged ETFs are used for short-term investment, short-term trading. I wouldn't even necessarily call it an investment. It's a trading vehicle. It's typically used in momentum type of trading, scalping, swing trading, etc. Again, this leveraged ETFs are not intended to be investments. They're not intended to be long-term holds. For example, options contracts have expiration dates and are usually traded in short term. It's difficult to hold long-term investments in leveraged ETFs because the derivatives used to create the leverage are not long-term investments. As a result, traders often hold positions in leveraged ETFs for just a few days or less. If leveraged ETFs are held for long periods, the returns may be quite different from the underlying index. And we'll see some real world examples of how this works in the future. So some of the pros of leveraged ETFs is they offer the potential for significant gains that exceed the underlying index. They have a wide variety of securities to trade using the leveraged ETFs. Again, we mentioned the various major indices, commodities, foreign currencies, etc. Investors can make money when the market is declining using inverse ETFs. And again, I would add to these, a pro is the ability to make money trading in a downtrending or bearish market in retirement accounts, which you again have difficulty doing normally in retirement accounts. Some of the cons of leveraged ETFs, they can lead to significant losses that exceed the underlying index. And again, we'll see examples of this coming up. Leveraged ETFs have higher fees and expense ratios as compared to traditional ETFs. However, above, we saw that the leveraged ETFs, even though it has a higher expense ratio, it may be cheaper than gaining that leverage using margin. Leveraged ETFs are not long-term investments. Again, these are trading vehicles for making money in a short term using, a momentum scalping swing trading strategy. So now let's look at a real world example of how a leveraged ETF works. Let's look at a real world example of a leveraged ETF and how they work as given in this Investopedia article. Here they're mentioning a Direction Daily Financial Bull 3X shares ETF called FAS. It holds equities of large U.S. financial companies by tracking the Russell 1000 Financial Services Index. So again, here's a 3X leveraged ETF. You can dig into details about this specific one, but it tells you the index that it's tracking, so that's always important to know. What is it tracking? And this particular ETF has an expense ratio of 0.99, and top holdings include Berkshire Hathaway, Visa, and JP Morgan. So again, it's the index. These are the components of the index, and this leveraged ETF is tracking that index. It has a 3x leverage. So this ETF aims to provide investors 3x the returns of the financial stocks it tracks, or again, the index that it's tracking. So in this case, this is a Russell 1000 Financial Services Index. So if you want to know the individual stocks that comprise that index, you would look up that index and see what the top holdings and what it is tracking. Also, you could track that particular index to see then what the performance of this leveraged ETF would look like. If an investor, for example, invested $10,000 in this ETF, FAS, and the stocks tracked from the index rose by 1%, so that particular index went up by 1%, the ETF would return 3% because it's a 3x leveraged ETF. However, if the underlying index declined by 2%, the FAS would have a loss of 6%. So again, it's a 3x leveraged ETF. So in the first day, if the daily increase in the index is 1%, the return on the leveraged 3x leveraged ETF would be 3%. If the index fell by 2%, the leveraged ETF 3x ETF would lose 6%. So within just that 1 day period, it's the leverage factor that tells you what the relative gain or loss would be based on the leverage. As stated earlier, leveraged ETFs are used for short-term moves in the market, can result in large gains or losses very quickly for investors, again, due to the amplification of the returns or losses based on the leverage factor. So again, I just wanted to highlight that this particular example in this paragraph is for a single day gain or loss in that index. And in subsequent examples, we'll look at how the recalculation, rebalancing of leveraged ETFs and how subsequent days affect the gains or losses in a leveraged ETF, which can be different from the gains and losses in the underlying index and or in other types of ETFs. And therefore, that's something that's important to understand about leveraged ETFs, is how subsequent gains and losses over time affect your returns or losses in a leveraged ETF. Okay, I also thought that it was important to gain a basic understanding of what is a leveraged ETF and how do they work. If we also walk through this investor alert underneath the SEC, the U.S. Securities and Exchange Commission, titled Leveraged and Inverse ETFs, Specialized Products with Extra Risk for Buy and Hold Investors. And again, I'll leave this direct link in the description box below so you can read this in the future and in more detail. You can see this came out in 2009. The SEC staff and FINRA are issuing alert because they believe individual investors may be confused about the performance objectives of leveraged and inverse ETFs, exchange-traded funds. Leveraged and inverse ETFs typically are designed to achieve their stated performance objectives on a daily basis. Some investors might invest in these ETFs with the expectation that the ETFs may meet their stated daily performance objectives over the long term as well. Investors should be aware that the performance of these ETFs over a period longer than 1 day can differ significantly from their stated daily performance objectives. So again, this is an alert from the SEC trying to warn investors to understand that the daily performance objectives of the ETFs can differ significantly over a longer period of time. And as we mentioned, therefore, they're not really intended to be a buy and hold or long-term investment vehicle. They're a trading vehicle. But again, we'll look at that in more detail in this alert and make sure you understand what a leveraged ETF is and how it works, and what the SEC wants to make sure that you understand about leveraged ETFs before risking your capital, trading with them, etc. Okay, we can see herein the SEC's definition of an exchange-traded fund or an ETF. ETFs are typically registered investment companies whose shares represent an interest in a portfolio of securities that track an underlying benchmark or index. So again, It has some kind of underlying benchmark or index, so it's important to understand what that benchmark or index is. Some ETFs that invest in commodities, currencies, or commodity currency-based instruments are not registered as investment companies. Unlike traditional mutual funds, shares of ETFs typically trade throughout the day on a securities exchange at prices established by the market. So again, just like a stock, it trades just like a stock, has a ticker symbol, trades during the day, etc. Has bid and ask on a market. ETFs have evolved over the years, becoming more complex. Investors considering ETFs should evaluate each investment closely and not assume all ETFs are alike. In the last few years, a number of leveraged and inverse ETFs have been introduced to the market that are very different from the traditional variety of an ETF. So again, typically an ETF will have a web page, a perspective that explains, what is its index, what is its underlying benchmark or index, what types of instruments is it trading, what's its expense ratio, what, if any, leverage factor is it trying to achieve, when does it rebalance or recalculate, etc. So typically an ETF that will have a web page with its constituents, its goal, its objective, etc. So I would highly recommend, if you're considering investing or trading in any kind of ETF, any kind of exchange traded fund, look at the web page, get the perspective, and review that, make sure that it meets your trading or investing goals. Okay, here's the SEC's definition of what are leveraged and inverse ETFs. Leveraged ETFs seek to deliver multiples of the performance of the underlying index or benchmark they track. So again, it's like every ETF, it's important to understand the index or benchmark they're tracking. Inverse ETFs, also called short funds, seek to deliver the opposite of the performance of the index or benchmark they track. So again, they're based on a particular index or benchmark, but they're trying to perform in the opposite directions. Like traditional ETFs, some leveraged and inverse ETFs track broad indices. Some are very sector specific. Others are linked to commodities, currencies, and some other benchmarks. Again, you can have a thematic ETF, a thematic leveraged ETF, which is focused on a particular theme. Inverse ETFs often are marketed as a way for investors to profit from, or at least hedge their exposure to downward moving markets. So again, another benefit of a inverse ETF is the opportunity to hedge a position, particularly again in a retirement account where you might not be able to trade things like options, futures, or do shorting. Inverse ETFs and inverse leverage ETFs give you a way to hedge your position or your exposure in a downward trending or bearish market. Leveraged inverse ETFs, also known as ultra-short funds, seek to achieve a return that is a multiple of the inverse performance of the underlying index. So again, it's an inverse ETF. The inverse ETF goes up when the underlying index goes down. And it has a leverage factor. So an inverse ETF that tracks a particular index, for example, seeks to deliver the inverse of the performance of that index, while a 2x times leveraged inverse seeks to deliver double the opposite of the index performance. Similarly, there can be 3x inverse ETFs. To accomplish their objectives, leveraged and inverse ETFs pursue a range of investment strategies through the use of swaps, futures contracts, and other derivative investments, such as options. Most leveraged and inverse ETFs reset daily, meaning that they are designed to achieve their stated objectives on a daily basis. Their performance over a longer period of time, weeks, months, or years, can differ significantly from the performance or inverse of the performance of their underlying index or benchmark during the same period of time. So again, this is important to understand. There objective is based on a daily basis, and their performance over longer period of times, weeks, months, or years, can differ significantly from the performance of the underlying index or benchmarks. And again, we'll eventually see some detailed examples of how that is. So again, these types of leveraged and inverse ETFs are not intended as long-term investments, long-term buy and hold vehicles. They're intended as trading vehicles to give you amplified rewards, which also come along with amplified risks, and also to be able to trade in a downtrending or bearish market. This effect can be amplified, magnified in volatile markets, as the example below demonstrates. An ETF that is set up to deliver twice the performance of a benchmark from the close of trading on day 1 to the close on trading on day 2 will not necessarily achieve that goal over weeks, months, years. So again, we'll look at some real-world examples, but it's again important to understand that the performance can differ and not necessarily achieve the goal or the performance of the underlying benchmark or index over weeks, months, years time frame, and therefore not intended to be held for those time periods. Okay, so here's some real life examples of how leveraged and inverse ETFs work from the SEC. Again, you can get the direct link to this and walk through these examples and convince yourself of how this all works, how leveraged ETFs work via this article from the SEC. And again, you can get this link in the description box below and walk through this and make sure that you understand how these work. So here's some 2 real-life examples that illustrate how returns on a leverage or inverse ETF work over longer periods of time and how those returns can differ significantly from the performance or inverse of the performance of their underlying index or benchmark during the same period of time. So in this example, they're showing that between December 1st, 2018 and April 30, 2009, particular index gained 2%. However, a leveraged ETF seeking to deliver twice that index daily return fell by 6%, and an inverse ETF seeking to deliver twice the inverse fell by 25%. So in this example, the index gained 2%, but the leveraged ETF actually declined by 6%, and an inverse ETF went down by 25%. So again, they'll walk through why this occurred. They explain during the same period, an ETF seeking to deliver 3 times the daily, so daily return of a different index fell by 53%, while the underlying index actually gained around 8%. So again, they'll explain, why there are these additional risks, why over a long period of time, these leveraged and inverse ETFs do not perform as the index does. So how can this occur? This longer-term index returns in ETFs happen. How can the breakdown happen? Here's a hypothetical example. So they walk through several days. So on day 1, the index starts with 100, a value of 100. So the leveraged ETF that seeks to double the return starts at 100. So on day 1, the index drops by 10 points. So it has a 10% loss. It has an ending value of 90. So the leveraged ETF then, which is a double 2x leveraged ETF, would drop 20% for that day and end at 80. So again, within a given day, a leveraged ETF will rise or fall equivalent to the gain or loss in the underlying index or benchmark times the leverage factor. So in this case, this is 2x. So the index went down by 10 points. So the 2x ETF went down by 20 points. On day 2, the index rises by 10%. So 10% of 90, it goes to 99. For the ETF, on day 2, it rises by 20%. So again, the daily increase is double what the daily increase is in the index. which means the ETF would have a value of 96. So again, because it decreased farther, it is farther away from its original value. The index itself is only 1 day or $1 from its original value, but the 2x leveraged ETF is now 4x or $4 away from its original value. So on both days, the leveraged ETF did exactly what it was supposed to do. It produced daily returns that were 2 times the daily index returns. Day one, the index went down 10 points, the 2x ETF went down 20 points. On day two, the index went up 20 or 10 points, and the leveraged 2x ETF went up 20 points. However, the net gain or loss is not equivalent. So the results over the 2-day period, the index lost 1%, while the 2x leveraged ETF lost 4%. So again, the loss factor is not the same as the leverage factor on the ETF. It's a 2x leveraged ETF, but the loss is 4x. So that means over the 2-day period, the ETF's negative returns were 4 times as much as the 2-day return of the index instead of 2 times the return. So again, this sequence, you could run this sequence out, for yourself with increases or decreases in the underlying index, and as you will see over time, the leveraged ETF is going to underperform because of this factor. So there's a time decay to these leveraged ETFs, which is why everyone says they're not intended for buy and hold. They're not intended for long-term investments. They are trading vehicles to allow you to amplify your returns as a trader. So again, that is their intent. That's how they perform best. And it's just important that you understand how they work and what your potential gains and losses may be over time. So here are some things to consider before investing in leveraged ETFs or inverse ETFs from this SEC alert. They say the best form of investor protection is clear understanding of leveraged or inverse ETFs before investing in them. So again, our objective in sharing with you this information is to make sure that you clearly understand what is a leveraged ETF, an inverse ETF, how do they work? How can you potentially benefit from them? What are the associated risks, etc.? If you understand, then that's the best form of investor or trading protection. So no matter how you initially hear about them, it's important to read the prospectus, get detailed information, an detailed understanding of the ETF's investment objectives, principal investment strategies, risks, and costs. So they reference the Edgar system, which is an opportunity to gain this information. There are a number of sources. We provide you with a number of resources on how to get information about ETFs as well. You can find the perspective on websites of the firms, etc. Again, go to their website, get the information. Should also consider seeking an advice of an investment professional. Be sure to work with someone who understands your objectives and tolerance for risks. Should understand these complex products. So again, if you're talking to someone and they don't understand what you're talking about based on this information, then that's probably not someone for you. They should be able to explain to you how these fit into your objectives or why they don't, and monitor your investment. Before investing in these instruments, leveraged ETFs, inverse ETFs, ask some questions of yourself or your investment professional. How does the ETF achieve its objectives? What are the risks? Make sure you understand the techniques the ETF uses to achieve its goals. Does it use short sales, swaps, futures, contracts, options, etc.? What is their strategy? How do they achieve that strategy? What's the exposure to the ETF and to you? What happens if I hold a longer than one trading day? So again, we saw some examples of the potential effects of holding these for a longer period of times, and that is really not the intent of these leveraged and inverse ETFs. and how that can affect your gains or losses. While there may be trading and hedging strategies that justify holding these investments longer than a day, buy and hold investors with intermediate or long-term time horizons should carefully consider whether these ETFs are appropriate. Again, these are not intended for long-term investment, a long-term buy and hold. As discussed above, because they reset each day, their performance can quickly diverge from the performance of the underlying index or benchmark. And again, you can walk through the details of these examples. It is possible that you could suffer significant losses even if the long-term performance of the index showed a gain, again, due to this factor. And again, there's an example, a previous example you can walk through to see why leveraged ETF or inverse ETF could suffer a greater loss than its underlying index, even if that index is showing a gain over that time period. Due to the amplification factor and the reset, the leveraged ETF or inverse ETF could show a loss. Is there a risk that an ETF will not meet its stated daily objective? Well, there's always a risk that it will meet its objective, will not meet its objective on a given day. Again, there are a number of factors that could cause that to happen. Be sure you understand the impact of an investment in an ETF that can have a performance on your portfolio, considering your goals and risk tolerance. Again, leveraged ETFs are amplifying the potential rewards, so they're also amplifying the potential risks. So if you do not have a corresponding risk tolerance, then these vehicles, these trading vehicles, may not be for you. What are the costs? Leveraged or inverse ETFs may be more costly than traditional ETFs. Here's a reference and a link to a fund analyzer so you can estimate the impact of fees and expenses on your investment. And there's also a mutual fund cost calculator so you can compare the cost of ETFs through various mutual funds. What are the tax consequences? Leverage or inverse ETFs may be less tax efficient than traditional ETFs because of the daily reset can cause the ETF to realize significant short-term capital gains that may not be offset by a loss. So again, tax implications are typically going to be a short-term capital gain. You may not be able to offset that with a loss. Be sure to check with a tax advisor about the consequences of investing in a leveraged or inverse ETF. So again, it's important that you understand these tax consequences and select a trading account, a brokerage account that matches your tax goals, etc. So for these reasons, it may be advantageous to you to trade the leveraged and inverse ETFs in retirement accounts, which you do not incur the short-term capital gains, or you don't have to pay the short-term capital gains tax. Whereas if you were in a non-qualified, non-retirement account, again, this may expose you to some significant tax exposure. So it's important to understand. As with all investments, it pays to do your own homework. Only invest if you are confident the product can help you meet your investment objectives and you are knowledgeable and comfortable with the risks associated with these specialized ETFs. So again, do your homework, do your due diligence, and it helps by your watching our videos. We hope that we can help you gain a better understanding of these trading vehicles and make a decision, a good investment decision for yourself as to whether these leveraged exchange traded funds, ETFs, and inverse ETFs are going to help you achieve your goals and succeed in your trading career. So we hope that this first video in our series on what is a leveraged ETF and how do they work will help you understand the basics of what is a leveraged ETF and start to understand how they work, how you can potentially use them to succeed in your trading career. Again, we will follow this up with a series of videos in more detail about what are leveraged ETFs, examples of leveraged ETFs, how do they work, again, in more detail with some additional examples to help you, again, see if leveraged ETFs are something that can help you succeed in your trading career, which is our goal. Um, if you have any questions, comments, what did you think of all this information? Do you find it helpful in understanding what leveraged ETFs are and how they work? Please leave a comment below. Let us know what you think of all this. If you have additional questions, please ask them as well in the comments below. Also, give us your feedback and ask any subsequent questions in our community, BeachBum Trading Community Discord and our BeachBum Trading Facebook group. You can always contact us via our numerous social media accounts. So we look forward to hearing from you. And what do you think about leveraged ETFs? Is this something that may help you succeed in your trading career? So we hope this all helps. Good luck and have a great trading day. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch list, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the BeachBum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.